Hello my fellow investors and welcome back to another stock analysis video. Today guys, we are going to be covering the company Johnson & Johnson, and the reason for this is, well guys, it is that time of the quarter again, and yeah, there's a lot of earnings happening this week. Now, I've asked in my community posts, hey, which ones would you guys like to see? And I got a couple of recommendations for Johnson & Johnson as well as Procter & Gamble, and I will 100% do Ally. Also got Abbott Laboratories, but guys, I will try to do my best when it comes to covering all the ones that you guys recommend, but I understand that there are a lot of companies out there, and you know, right now this week is going to be crazy, and then the following week when the tech companies start putting out their earnings is going to be even worse. So I'm going to try to get as many as I can, the ones that you guys recommend, as well as covering the earnings the day that it comes out, though they may come out at later days following when their earnings actually come out. So just please bear with me on that. There are a lot of companies out there, but today we are going to be covering the company Johnson & Johnson, which a lot of you guys actually recommended. So with that said guys, let's get started with this analysis. Now before we actually get started with any numbers guys, understand that Johnson & Johnson is a pharmaceutical company, and when it comes to pharma companies, the main thing that you have to take a look at is essentially their pipeline when it comes to drugs, which ones are in phase 1, phase 2, phase 3, and the registration phase. Obviously, though further in the phase they are, the better it is. Also take a look at which ones are expiring as well, because if you have a drug that's expiring that brings in majority of the revenue, then unless they have something else that may subsidize that revenue that's going to be gone in the next couple years when other companies are allowed to copy and make it generic, then you will probably be losing that revenue. But here is guys the pharmaceutical pipeline for Johnson & Johnson. I will leave this link in the description below, but you guys can also just look up Johnson & Johnson pipeline and it'll be the first link that comes out. Now with that said guys, let's head over to guys some other news when it comes to Johnson & Johnson, and this is also something that recently occurred, and they're going to spin off a certain business of theirs. You can see right here, finally Johnson & Johnson names consumer health business Kenvue ahead of spin-off. JNJ named its consumer business Kenvue on Wednesday, moving ahead with its plans to spin off the unit in what would be the biggest shakeup in the healthcare conglomerate in 135-year history. The unit faced nearly 40,000 lawsuits alleging its baby powder and other talc products contained asbestos, later linked to mesothelioma and ovarian cancer in women who used the personal hygiene, which the company has denied. So yeah guys, unfortunately Johnson & Johnson is actually spinning something off which had to do with their talcum powder, and that's also going to hurt their revenues a significant amount. But then again guys, you saw there 40,000 lawsuits in total, which is absolutely insane. Then again guys, Johnson & Johnson has been in business for how many years? I mean 135 years, so that's insane. Obviously you're going to have multiple lawsuits. People always try to do these kinds of things in order to get money out of them. So those are things guys that you probably may want to keep in mind while we make this analysis. Now with that said, let's come over here to the dividend summary, because this actually guys is one of the major players when it comes to the dividend king atmosphere. We got the dividend yield of 2.75%, which ends up being $1.13 per share for an annual payout of $4.52, a payout ratio of 43.14%, and a 5-year CAGR of almost 6%, with 59 consecutive years of dividend growth, which is actually really solid. Even with all those 40,000 lawsuits guys, they were still able to pay out this dividend. Ex-dividend date passed as of August 22nd, and payout date was September 6th, and they pay their dividends quarterly. Coming down to the calculator guys, we got the ticker symbol for JNJ, market cap of $432.4 billion with a PE of 23.91. So it is a little bit high in accordance to what I like. I like anything under 20, but guys, 23.91, this may actually be like an okay kind of premium to pay for this kind of company, not gonna lie. Obviously you have to take into account against the lawsuits, but then again guys, 135 consecutive years of being in business, that does give it a lot of big reputations if I do say so myself. So with a current share price of $164.46, PE of 24, essentially 24, this might actually be a very good buy right now. And looking at their graph guys, we can see that they really haven't moved. On the 1 year they are up only 2.72%, and on the year to date they're down 4.13%. On the 52-week ranges, it's only between 155 and 186. So again, not really that much movement happening throughout the entirety of the 1 year graph. Now, seeing that they do pay out a $4.52 in annual dividends per share, this comes out to be almost $12 billion being paid out in dividends every single year. Based off of their 5-year average free cash flow, they're still left with $7.4 billion, and honestly, the same as for the last year's free cash flow, which is at almost $7.9 billion. These payout ratios come out to be 60.14% for the last year's free cash flow and 61.78% for the 5-year average, which is actually, guys, I know that I like to buy under 60, but 60 and 61, it's not really that much of a difference. And the fact that, again, this is Johnson & Johnson, this is actually fairly good, because it essentially means that they might actually be able to continue growing this dividend even more into the future. So now coming into some fundamentals, guys, starting of course with the net income. 5 years ago of $1.3 billion to 1 year ago of $20.9 billion, increase of 1,506%. Absolutely crazy, guys. Now, the main issue here is its 5-year ago value of $1.3 billion, and then it just shoots up from 5 to 4 years ago from $1.3 to $15.3 billion, guys. That is absolutely insane. And then also from 4 years ago to 2 years ago, it kind of remained stagnant. If anything, it was going down slightly. So again, kind of concerning there too. And also on top of that, guys, 2 years ago to 1 year ago, a massive jump occurred, going from $14.7 billion to $20.878 billion. Now, this was probably due because of COVID and their COVID vaccine, obviously. A lot of the vaccines started to be rolled out the following year in 2021, not 2020. So I think that may be the reason as to why this occurred. But I don't like the stagnation here as well as this 5-year ago value being this low. So for that reason, I'm actually going to give this guys like a 60%. Coming now into the free cash flow, we got 5 years ago of $17.78 billion to 1 year ago of $19.76 billion, increase of 11% with an average of $19.2 billion. Now, the funny thing here is that, guys, is actually was increasing from 5 to 2 years ago, and then it actually decreased 1 year ago, going from $20.2 billion to $19.7 billion. What caused this little dip? I don't necessarily know, but I don't think it's too much of an issue though, in my personal opinion. So for that reason, guys, I'm going to give this essentially like a 75%. To me, it could be a lot better consistently increasing in my personal opinion, but nonetheless, it is still an increase on the 5-year of 11%. And let's face it, $19 billion in free cash flow is absolutely crazy. Coming now into the revenue, we got 5 years ago of $76.45 billion to 1 year ago of $93.8 billion, increase of 22.66%. And guys, this one's actually really consistently increasing, and I like that. There really aren't that many outliers here to look at, maybe from like 2 years ago to 1 year ago, but it really wasn't that much, only an increase of around like $10 billion or so. So for that reason, guys, I'm actually going to give this like a 95% for a percentage point. Coming down to the total assets minus the total liabilities, this one's also looking very good, guys. Currently, they're at $76.4 billion. Now, from 5 to 3 years ago, it was kind of stagnant. It was actually decreasing, honestly. And then 2 years ago and onward is when it started going up. But overall, it's definitely not too bad. And they have a lot of total assets minus total liabilities left. Average total assets is $167.1 billion. Average liabilities is $101.6 billion, and doing this difference, we get $65.5 billion. I'm going to give this guys like an 85 grade. It's okay. I don't like the stagnation here, but overall it is going up. Coming now into the cash flow minus the liabilities, looking at this, guys, they're currently at negative $88.2 billion, and that's actually a little bit of an increase from the lowest point 2 years ago. And on top of that, they also had some increases from 5 to 4 years ago. But overall, as you can clearly see, they are kind of stagnating around this like $70 billion mark, $80 billion mark. So it's actually kind of meh. They do have some instances where they're at least trying to bring it back down to zero. Average cash flow minus the average liabilities, it is negative $82.4 billion. I'm actually going to give this guys like a 60%, maybe even like a 55%. They do have instances of it going up, but only twice. So that's essentially why I'm giving it a 55%. Coming now into the shares outstanding, the metric that people tend to overlook. And unfortunately, guys, we can't overlook this, because if you like that dividend, a company that issues shares, guess what? That actually makes the dividend to be paid out even harder, because there's more shares for that dividend to be paid out. A company that's buying back shares is actually allowing the dividend to be paid out much better, because they don't have that many shares for that dividend to be paid out in the first place. So Oh, so it isn't overall good on top of just the company giving you a bigger piece of ownership just by buying back shares. And when it comes to Johnson & Johnson, guys, again, they're a massive corporation. So it's not surprising that they are buying back shares at around 2%. 5 years ago of 2.7 billion shares to today of 2.63 billion shares, is again decrease of 2% on the 5-year, and from the previous year to the current year, that's another decrease of 0.13%. Now the one thing I really do have to mention here, guys, is that take a look at this. During COVID, they actually didn't issue shares. They actually kept it the same from 3 years ago to 2 years ago. So that's actually really good. And then on top of that, they kept it the same as well from 1 year ago to today. So that's actually fairly interesting to see. So I'm going to give this shares outstanding, guys, an overall grade of like 80%. It could be better. They could be buying back more shares, but overall it's still really respectable. And now looking at the cash and equivalents, they currently hold almost $11 billion with an average of $15.44 billion. So now looking at the overall grades when it comes to this, guys, we gave the net income a 60%, free cash flow 75%, revenue 95%, assets minus liabilities 85%, cash flow minus liabilities 55%, and the shares outstanding of 80% for an overall grade, guys, of 76%. Yeah, it's kind of what I would expect when it comes to a company that has been alive for 135 years and it's still going. Kind of a little bit more than average, right? It's a little bit better than average. So 76%, I think it's a fair grade for this company. But now the question lies, what price do we pay for this company? Because at $164.46, who knows, right? Who knows if this is a good price or not? So let's make assumptions: low, medium, high. Changing revenue growth, projected share buyback, and keeping a required rate of return the same at 10%. Coming over here, guys, to Seeking Alpha, we can see that the forward is expected to be at 6.07% when it comes to the revenue growth. So let's actually make these revenue growth assumptions for 4%, 6%, and 8% for the low, medium, high assumption. Now for the predicted share buyback, guys, they've only been buying back at around 2% of shares, and they have occasionally done 0. So let's actually go with that. Let's put 0 for the low assumption, let's say 2 for the medium, and let's go with around 4 for the highest assumption. Now that one is a little bit pushing it, but let's just go with 4. Now with that, guys, we get target share prices, not adjusting for debt, of $154.79 to $184.84. Adjusting for debt, this actually goes up by around $4 or so, meaning that they actually have a lot more cash on hand than they do debt, which is actually really good. And doing so, this puts me between the ranges of $158.96 to $189.18. And adding a margin of safety of 5, 10, and 50%. This puts me between the ranges of around $135.11 at the lowest one, meaning the lowest assumption, highest margin of safety, to $179.72 for the highest assumption, the lowest margin of safety. Guys, at the current share price of $164.46, honestly, I understand that there are some points here that's saying that you would still need to wait. In my personal opinion, take a look at the median assumption, because in this case scenario, guys, we are essentially there when it comes to the margin of safety of 5%, adding the target share price, adjusting for debt. And on top of that, guys, even though this is a little bit expensive when it comes to the low assumption, I still think that when it comes to a company like this, you might be willing to pay that premium, especially since who knows when this company might fall to a +10 kind of range when it comes to these target share prices. This is why I'm a believer that you probably should not wait until things fall to this exact price, because for all you know, starting this week, the market might shoot up for all we know, right? And then you'll be like, oh my god, I wanted to buy it at this point, but now I can't because now it's worth $200, and now you're really not willing to buy it, right? If you're not willing to buy it at 164, then you're really not going to be willing to buy it at 200. But again, I think that 100% you should take into account this kind of premium, because it's what you're getting in return, right? You're getting a massive dividend, and on top of that, you're getting a really big corporation that might give you a lot of prospects in the future when it comes to their free cash flow. That's just something to think about. Now, obviously, that's just something that I would do. I'm not telling you guys what to do. This is not financial advice, and please make your own assumptions. Every investment is the present value of all future cash flow. Have this calculator, guys. It is for free, as well as my book value calculator, my re-evaluation calculator, and a dividend tracking sheet where you guys can track these kinds of companies. In fact, if I can actually show you all here, I have Johnson & Johnson right over here. It's paying me $2.32 every quarter. might want to increase it now that it's fallen to this point. Who knows? But that's something that I like to do, guys. I like to track it, and I like looking at these calculators. That's why I'm giving them out for free. All I'm asking for in return is just help me grow my channel. Like, subscribe, comment. It really does help her with the algorithm on YouTube, guys. That's really all I'm asking for. Now, with that said, let's actually take a look at this dividend, because it is a dividend king, guys, and $4.52 is nothing to laugh about. And well, putting in $5,725, this nets you $157.35, which is not a lot, right? There are better ones out there that give a lot more, but then again, guys, we're talking about Johnson & Johnson, right? I would love for this thing to fall to like 154. If this thing were to fall $10 more, guys, this would actually net you $168. See, that's kind of my point. There really isn't that much difference from the current share price to the lowest assumption share price. Again, $157 could be a lot more, but then again, guys, it is Johnson & Johnson. All in all, when it comes to this company, guys, as I said, I personally would take the L when it comes to paying this small premium of around $10 or so, but it really just depends up to what you would do. I like this company. I don't think they're going away anytime soon, and they are an absolute cash cow. That pretty much is it for this video. Like, if you like, comment, subscribe. It really does help her with the algorithm on YouTube. You guys can follow me on my new tech sites, link in the description below. So with that said, peace out, and I will see you all in the next stock analysis video.